Welcome to The Deep Dive, the show where we cut through the noise and deliver the crucial insights you need to be truly well-informed without ever feeling overwhelmed.
Glad to be diving in.
Today, we're plunging into a question that is quite literally worth billions, even trillions, really. What truly determines the value of a company's stock?
It's a fundamental question, isn't it?
Absolutely. Have you ever found yourself wrestling with whether it's simply about trying to predict earnings way out into the future, or if there's maybe a more fundamental, often overlooked force at play?
Well, it's a question that has kept investors, analysts, academics, pretty much everyone in finance up at night for decades, and for good reason.
Right.
Because the stakes are incredibly high. It influences everything from, your individual investment decisions right up to multi-billion-dollar corporate strategies.
Yeah.
And the imprecision in the traditional ways of valuing companies. That's long been a source of both frustration and, frankly, significant financial risk.
That's it. And today we're embarking on a deep dive into a groundbreaking approach that challenges a lot of that conventional wisdom. Our mission is to unpack a fresh methodology for valuing a firm's equity, one that fundamentally flips the script.
Flips the script is a good way to put it.
Instead of looking at a company's value from the perspective of investors demanding securities, which is, the typical angle this new lens comes from the viewpoint of managers supplying capital assets.
Exactly. We'll be exploring what's termed the supply approach to valuation, a concept meticulously detailed in a really important paper published back in 2013 by Federico Bello, Chen Su, and Lu Zhang.
Right. Bello, Su, and Zhang.
Their work offers a surprisingly elegant and robust answer to some of the most persistent challenges in finance. Really quite compelling stuff.
So get ready for some genuine aha moments as we extract the most important nuggets of knowledge from their research. We're going to deliver surprising facts, offer insights that will, quite frankly, reshape how you think about company valuation.
Hopefully, yeah.
You'll learn why this new approach manages to sidestep some of the biggest headaches in traditional valuation and what it means for anyone looking to understand a company's true worth. So let's start by setting the stage. Why do we even need a new approach in the first place? What's wrong with the old ways?
So to truly appreciate the elegance and the power of this new perspective, we first need to understand the valuation puzzle that has long challenged the financial world.
Definitely. It's not just an academic curiosity. It's a daily struggle for anyone making investment decisions.
Right.
That's precisely right. For decades, the bedrock of financial analysis has been what we call present value models for equity valuation.
Okay, the standard stuff.
Yeah, these are the models you learn in every business school globally. They're widely practiced across the financial services industry. Think of methods like the dividend discounting model.
Valuing based on future dividends.
Right, or the residual income model, championed by researchers like Olson back in 95, and DeChou, Hutton, and Sloan in 99, or Frankel and Lee in 98. And that one looks at earnings above the cost of capital, right?
Exactly. It values a company by adding the present value of its expected future residual income, those earnings above the cost of capital, to its current book value. Standard practice.
And conceptually, these models sound perfectly logical, don't they? I mean, a company's value, in theory, is the present value of all its future cash flows or earnings it generates for its owners. Seems straightforward.
It does sound straightforward.
But here's where it gets really interesting and really difficult, because implementing them in practice is notoriously problematic. What makes them so hard to use reliably?
Well, it all boils down to the inputs. The primary and often, almost insurmountable hurdle is forecasting earnings or cash flows.
Ah, the crystal ball problem.
Precisely. We're not talking about next quarter or even next year's performance, but many years into the future. Imagine trying to predict a company's revenue, its expenses, its capital expenditures, 5, 10, even 20 years from now.
Especially today, things change so fast.
Exactly. In today's rapidly changing tech-driven markets, will new competitors emerge? Will consumer tastes shift dramatically? Will some new regulation just completely alter the business landscape?
Right.
This task is fraught with immense uncertainty and, as the authors note, often relies on highly subjective, ad hoc assumptions. It's like trying to predict the exact path of a butterfly a year from now. It's just incredibly difficult.
That sounds incredibly speculative. Okay, so that's forecasting.
Right.
And then there's the other critical input, which is just as notoriously difficult. The discount rate?
Yes, the discount rate.
This is the rate you use to bring those imagined future cash flows back to a present value, right? Making them comparable to today's money.
And this is where things get even murkier, if you can believe it. It's well known in finance that discount rate estimates, particularly those derived from standard asset pricing models like the capital asset pricing model or CAPM.
PAPM, everyone learns that one.
Right, they're extremely imprecise.
Hmm.
CAPM, which is a common way to estimate the expected return of an investment based on its systematic risk, relies heavily on predicting the market risk premium.
Which is basically how much extra return investors expect for taking on market risks.
Exactly. But as Penman, a leading authority, points out in his 2010 valuation textbook, and this is a direct quote, no one knows what the market risk premium is.
Wow, no one knows. That's blunt.
It is. He goes on to state that this uncertainty leads to a considerable problem when applying models like CAPM.
That's a remarkably blunt admission from a textbook. And Lundholm and Sloan, in their 2007 work, they echo this, right?
They do. They lament that the discount rate has a large impact on the result, yet you will rarely feel very confident that the rate you have assumed is the right one.
So you're not even confident in the number you're using.
And yet they emphasize this imprecision makes valuation estimates extremely sensitive. Even small changes can have huge effects.
Okay, so let me recap. You have two fundamentally critical inputs: future cash flows and the discount rate. Both incredibly hard to pin down with any certainty, and both capable of swinging your final valuation figure dramatically. It sounds like a recipe for frustration.
It is, and this collective frustration led John Cochrane, a really prominent figure in asset pricing, to highlight a surprising lack of valuation research in his field back in 2011.
He noticed people weren't focusing on valuation itself.
Yeah, he questioned why the focus had shifted from asset pricing, truly understanding what determines value, to merely asset expected returning, which focuses more on just forecasting future returns.
He explicitly asked, what is the source of price variation? He made a powerful argument that market-to-book ratios, a firm's market value divided by its book value, should be the left-hand variable in our equations.
Meaning the thing we're trying to explain.
Exactly. It's the thing we're trying to explain and understand, not just a characteristic we use to sort companies or predict expected returns.
That's a profound point.
Yeah, this critique really underlines a fundamental gap in our understanding of what drives asset prices and, crucially, creates the perfect space for a fresh new perspective, which is exactly what we're exploring today with this supply approach. Okay, so if the traditional demand-side approach, where investors' demand for securities dictates value, is so tricky because of those notoriously uncertain inputs.
The forecasts and the discount rates.
Right. What is this new supply approach all about? How does it actually work? How does it flip the script?
The core idea here is surprisingly simple, actually, yet profoundly powerful, because it completely shifts our viewpoint.
Okay.
Instead of focusing on investors' demand for a company's shares, this new methodology tackles valuation from the perspective of managers' supply of capital assets.
So thinking about the actual stuff the company owns and builds.
Exactly. Think about it this way. Ultimately, a company's market value derives from the real assets it owns and operates: its factories, its equipment, its intellectual property, its technology. These are the physical and intangible assets that generate the actual economic value.
So we're looking at it from the perspective of the people actually making the concrete physical investments within a company, the managers themselves. It's almost like observing the company from the inside out.
Precisely. The core idea is that if managers are behaving optimally, that is, making smart, value-maximizing decisions, they will continually adjust the supply of capital assets through investment in response to changes in their market value.
Okay.
It's a continuous, dynamic process driven by economic rationality.
Okay, that makes intuitive sense. But what does behaving optimally truly mean in this specific financial context for managers? Like, what are they actually balancing?
It means they will invest in capital assets until the marginal benefits of adding one extra unit of assets exactly equate the marginal costs of supplying that extra unit.
Marginal benefit equals marginal cost, classic economics.
Exactly. To use an analogy, imagine a bakery deciding whether to buy one more industrial oven. They'll keep adding ovens or any other unit of capital until the expected future cash flows and increased efficiency generated by that very last oven.
The marginal oven.
Right, the marginal oven, which we call marginal Q, perfectly matched the total cost of acquiring and installing it. At that point, any further investment wouldn't be as profitable, and any less investment would leave profitable opportunities on the table.
So managers are essentially making these precise decisions at the margin, right? When the benefit of adding one more unit of capital perfectly balances the cost of adding it, That's where they stop.
That's the optimal point.
And if we can observe their investment behavior and understand those costs, we can somehow infer the true value of their assets. Is that the leap?
That is the ingenious part. With a specified capital adjustment technology, essentially, a detailed understanding of how easily and at what cost a company can adjust its capital stock.
How easy is it to build that new factory or upgrade the software?
Right. We can infer these marginal costs of investment, and therefore the marginal Q. What's truly groundbreaking is that under specific conditions, known as the Hayashi conditions from 1982,
Okay, Hayashi conditions.
which basically state that if a company's production and investment costs scale proportionally, or exhibit constant returns to scale.
So double the inputs, double the costs and output.
Roughly, yes. Under those conditions, then Tobin's Q, which is the market value of a firm over the book value of its capital assets, actually equals this marginal Q.
Wow. Okay, so Tobin's Q, which we can observe from market and accounting data, actually equals the marginal value of investment under these conditions.
Correct. So if those Hayashi conditions hold, we can essentially back out the value of a firm's entire installed capital assets just from managers' costs of supplying those assets.
That's a significant conceptual leap. It implies that if investors see managers investing more, aggressively adding capital,
They can infer that the marginal Q is higher, meaning the value the market places on those assets is also higher.
because managers wouldn't invest unless the marginal benefit justified the cost.
It's a direct, observable, and economically grounded link. This brings us to a familiar concept, Tobin's Q, but reimagined as the central measure of valuation in this supply approach.
So Tobin's Q isn't just some financial ratio anymore.
Exactly. Tobin's Q, defined as the total market value of the company's equity plus its debt, divided by its total assets, becomes the observable proxy for this marginal value of new investment. It's not just a ratio, it's a direct, almost transparent window into the optimal decisions managers are making about their real productive assets.
It connects the financial markets directly to the real economy. That's powerful.
This sounds like a much more tangible and, well, less speculative way to look at valuation. So what are the practical advantages of this supply-side approach over the traditional methods that have caused so many headaches?
Well, the supply approach offers two major practical advantages that directly address those notoriously difficult inputs we discussed earlier with traditional demand-side models.
The forecasts and the discount rates again.
Exactly. And these aren't just theoretical benefits. They offer real-world relief for analysts and investors.
Okay, let's unpack the first one. It sounds like it tackles the crystal ball problem of long-term cash flow forecasts. How does it manage that? Absolutely. The first major advantage is that it completely eliminates the need for those incredibly speculative long-term cash flow forecasts.
Gone, just like that.
Gone.
Yeah.
As we noted, the demand-side approach requires predicting earnings or cash flows many years into the future, a task often reliant on ad hoc assumptions, susceptible to analyst bias, and just fraught with immense uncertainty due to market dynamics, tech shifts, competition.
Yeah, all that stuff we talked about, the sheer number of guesses you have to make.
Exactly. Think of the sheer volume of detailed assumptions an analyst has to make. Sales growth rates, profit margins, capital expenditures, working capital changes, all extending 5, 10, even 20 years out. It's a tremendous and often, frankly, futile burden.
So no more trying to predict what, say, Apple will earn in 2035 or how Google's ad revenue will evolve over the next decade. That sounds like an analyst's dream. It frees them from what often feels like pure guesswork.
It truly simplifies things dramatically on that front. The supply approach only requires one key input that is readily observable in financial statements today: the current period investment to capital ratio.
Just the investment rate now.
That's the key observable.
Sure.
Through an estimated capital adjustment cost function, which we'll discuss more, this ratio directly leads to marginal Q, which then allows us to value a firm's installed capital assets. This, as the authors say, relieves us of the burden of forecasting earnings or cash flows.
Wow.
You don't need a crystal ball. You just need to observe current, tangible actions and understand the costs associated with those actions.
That's a huge shift in practical terms.
Okay, so that's forecasting avoided. What about the second advantage? Does it help us escape the discount rate dilemma, which is another massive source of uncertainty?
Indeed it does. The second advantage is that this approach does not need to take a stand on the discount rate at all.
It doesn't need it at all.
No. We've talked about how discount rate estimates are extremely imprecise and, as Penman vividly put it, contain a strong element of smoke and mirrors. Right, the no one knows the market risk premium problem.
Exactly. You rarely feel truly confident that the specific rate you've assumed is the correct one. Yet even a tiny adjustment to that rate can have a massive impact on the final valuation result. It introduces this arbitrary, yet hugely influential element into the valuation process.
So the supply approach just bypasses that entire headache. How can it possibly value a company without knowing the discount rate? That seems fundamental to any present value calculation.
It achieves this by deriving its parameters not from subjective financial market expectations of returns, but from the actual technological costs associated with adjusting capital.
Okay, technological costs, like the cost of building things, installing
Yeah,
things.
the real-world costs. When we equate Tobin's Q directly to the marginal costs of investment, the model is essentially asking, what are the real-world costs incurred by managers to create this amount of capital, and what is the market valuing that capital at? These parameters, describing the cost of investing and expanding, are technological in nature.
Ah,
As Nobel laureate Robert Lucas suggested back in '76 in his critique of traditional econometric models, parameters derived from fundamental technology and preferences should ideally be invariant to changes in optimizing behavior and economic policy.
meaning they should be more stable, less affected by market moods or policy changes.
Exactly. This makes them inherently more stable, less prone to the fluctuations and imprecisions that plague reduced-form parameters, like the discount rate in traditional models. It's like valuing the machine based on its construction cost and output capacity, not on someone's guess about future interest rates or market sentiment.
So, what does this all mean for you, the listener? We're talking about valuing a company based on its observable physical investment decisions and the economic costs of making those decisions,
Tangible actions and costs.
rather than trying to predict the unpredictable future or guess an elusive discount rate. It feels much more tangible, much more grounded in the company's real assets and actions. It's about what a company is doing now, not just what it might do later. Okay, so we understand the core idea of valuing from the supply side and its profound practical advantages, like avoiding forecasts and discount rates. But how does this all work in a formal model? What are the actual components that make up this Q theory of investment when used as a valuation tool? Let's get into the nuts and bolts a bit.
Right, let's peek under the hood. To formalize this powerful intuition into a rigorous valuation tool, the authors developed the Q theory of investment specifically to pinpoint the levels of asset prices across the cross-section of firms.
So not just explaining returns, but the actual price levels.
Exactly. The key is that the valuation equation directly links Tobin's Q, the observable market value relative to book value, to marginal Q, which, as we discussed, is inferred from observable investment data using a carefully specified capital adjustment costs function.
So it starts with the firm's fundamental decision-making process, right? What are the core elements a firm considers when making these investment decisions in this model?
Exactly. Firms are assumed to behave rationally, maximizing their market equity by choosing optimal levels of investment and debt. Their operating profits are seen as a function of their capital, which we denote as KIT for firm I at time t, and various shocks, XIT, that might impact their business.
Standard stuff.
Pretty standard. The model uses a common economic concept, a Cobb-Douglas production function, with constant returns to scale.
Okay, Cobb-Douglas just means a standard way to relate inputs like capital to outputs like sales, right?
Right.
And constant returns means efficiency stays the same as you grow.
You got it. That assumption implies that the marginal product of capital, the extra output from one more unit of capital, is directly proportional to the sales to capital ratio. Capital itself is assumed to depreciate at an exogenous rate. Delta IT exogenous meaning is determined outside the firm's immediate decision, and it could be firm-specific and time-varying, reflecting wear and tear or obsolescence. And then investment, IIT, simply adds to the existing capital stock. So KIT plus 1, the capital in the next period, equals the current investment plus the undepreciated portion of current capital, which is 1 delta IT times KIT.
That sounds like standard corporate finance and economics, the basic mechanics of capital accumulation. But you previously mentioned capital adjustment costs. That sounds like a particularly key piece here.
It is absolutely critical.
Because it's not always easy or cheap to, say, build a new factory, upgrade software, or launch a new product line. There are frictions involved.
You're absolutely right. These frictions are crucial. Firms incur significant costs when adjusting their capital. That is, when they invest or disinvest. The adjustment costs function, denoted APhi of IIT and KIT, is meticulously designed to capture this.
How does it work? What are its properties?
It's assumed to be increasing and convex in investment. Increasing means more investment costs more, obviously. Convex means the costs accelerate as the pace of investment increases.
Like rush jobs costing more.
Exactly. Think about rushing to build a new plant. You might have to pay overtime, expedite materials, offer premiums for scarce resources, pushing up the marginal cost disproportionately. The function is also decreasing in existing capital, reflecting that maybe larger firms find it easier to absorb new investment costs. And it exhibits constant returns to scale in investment and capital together.
Okay, convex costs. And what's particularly important and innovative about how this function is structured in the author's model? You mentioned something about nonlinearity before.
Yes, here's where it gets truly nuanced and powerful. The model allows for nonlinear marginal costs of investment. This is represented by a parameterized function with two key variables, a slope parameter, eta, and crucially, a curvature parameter, nu.
Eta and nu.
Where nu equals 2, the function simplifies to the standard quadratic form. That implies linear marginal costs, meaning each additional dollar of investment costs the same at the margin as the previous one, in terms of adjustment friction.
But they let nu be something other than 2.
Exactly. By allowing eta to be different from 2, the model can capture more realistic nonlinear relationships, where the marginal cost itself curves upwards more steeply. This ability to capture greater curvature turns out to be quantitatively very important for the model's success in fitting real-world data, as we'll see later.
Interesting. So they're not just assuming a simple cost structure, they're letting the data tell them how those costs truly behave, how convex they really are.
Precisely, it builds in more flexibility and realism.
And I assume the model also incorporates real-world complexities like financial structure and taxes. It's not happening in a vacuum.
Yes, it certainly does. The model incorporates corporate taxes, denoted TOT, and allows firms to finance investment with one-period debt, BIT plus 1. It meticulously accounts for real-world tax benefits like depreciation tax shields.
Where depreciation lowers your taxable income.
Right. And interest tax shields, where interest payments on debt are tax-deductible, reducing a firm's tax burden. These are all considered when defining a firm's payout, DIT. So all these elements make the model more robust and applicable to the intricate realities of corporate finance.
So bringing it back to the valuation, what's the core valuation equation that comes out of all this in plain English? How does it actually connect all these pieces to the firm's value?
From the firm's optimal investment decisions, specifically the first-order condition that managers use to decide how much to invest the market value of the firm, which includes its equity plus its debt.
The total enterprise value, essentially?
Yes, that value is directly related to the marginal cost of investment. This includes both the marginal purchasing costs of the new assets themselves and those crucial marginal adjustment costs we just discussed.
So the firm's total value can be inferred directly from its observed investment and the costs involved in that investment.
In essence, yes. It's a very elegant and direct relationship, bypassing the need for those speculative cash flow forecasts and discount rates.
That's quite a powerful inference, directly linking observable actions to intrinsic value. But is there anything else that anchors this to fundamental economics, beyond just the observed investment, to ensure it's not just chasing market whims or temporary mispricing?
Yes, there is a crucial anchor. In addition to the valuation equation, the model also utilizes an investment Euler equation.
Euler equation. Sounds important.
It is critical because it essentially states that the marginal cost of investment at time t must equal the expected present value of the marginal benefits of that investment at time t plus 1. Think of it as a dynamic equilibrium condition. Cost today must balance expected benefits tomorrow.
Okay, and what are those future benefits?
These marginal benefits are comprehensive. They include the after-tax profits generated by the new capital, any reduction in future adjustment costs from having more capital, since adjustment might be easier with a bigger base, the depreciation tax shield we mentioned, and the continuation value of that capital, what it's worth beyond the next period.
So this Euler equation ensures that managers' investment decisions are truly tied to economic fundamentals, the actual long-term value generated by the capital itself.
Exactly.
Almost independent of any potential market misvaluation that might temporarily distort stock prices. It grounds the model in real economics, not just market sentiment.
That's precisely right. It serves as a crucial economic anchor, ensuring that the model reflects managers' long-term fundamental value creation. And finally, under the assumption of constant returns to scale, the model establishes a clear and elegant link between investment returns and stock returns.
How so?
Specifically, the investment return, which is the ratio of marginal benefits from new capital to the marginal cost of supplying that capital, is shown to equal the weighted average of the stock return and the after-tax corporate bond return.
Okay.
This means the stock return itself could be expressed as what the authors call a levered investment return, directly connecting a company's real investment performance to the returns its shareholders receive.
So we have a complete and internally consistent framework. It connects physical investment decisions to firm value through costs, anchors it in fundamentals with the Euler equation, and links it all back to stock returns. Seems very thorough. So we've covered the theory, the core idea, the advantages, and the mathematical framework behind this supply approach. Sounds impressive. But how well does this intricate model actually perform when put to the ultimate test against real-world data?
This is where it gets really compelling.
Do these theoretical connections hold up empirically, or does it just look good on paper?
What's truly compelling here is how strongly the model's predictions align with observed market data. The researchers employed a powerful statistical technique called generalized methods of moments, or GMM, to evaluate the model's fit.
Okay, a sophisticated way to test models against data.
Exactly. GMM is a statistical method that helps us test if our theoretical model aligns with real-world data, even when we don't have perfect information about the data's underlying statistical properties or if there are, measurement errors. It's particularly useful in financial economics. And a crucial methodological choice they made was to conduct estimation and tests at the portfolio level.
Portfolio level, meaning they grouped firms together.
Yes, they aggregated firm-level data into portfolios rather than analyzing each individual firm separately.
Okay, that's interesting. Why the portfolio level instead of individual firms? Does that make a significant difference, and what's the intuition behind that decision?
It makes a very significant difference. Aggregating data to the portfolio level substantially reduces the impact of what are known as measurement errors in firm-level data.
Noise in the data for single companies.
Right. Think about it. A single company's reported investment or capital figures might have some noise or accounting quirks, maybe timing issues. These idiosyncratic errors have plagued the empirical performance of investment regressions in the past. They create a lot of statistical noise, making it hard to see the underlying economic relationships clearly.
But averaging them out helps.
Exactly. By averaging these errors out within portfolios of similar firms, the tests become much more reliable and powerful, allowing the true economic signal to shine through. It cancels out some of the random noise.
That's a clever way to handle real-world data imperfections. So what were the testing assets they used to challenge the model? How did they pick the companies or portfolios to evaluate?
The primary testing assets were 10 deciles formed on Tobin's Q. They took all common stocks on the New York Stock Exchange, Amex, and NASDAQ from 1963 to 2011.
Wow, it's a long period, nearly 50 years.
A very robust and long sample period, yes, excluding utilities and financial firms, which often have different dynamics. They sorted these firms into 10 groups based on their Tobin's Q ratio, from the lowest Q firms to the highest Q firms.
And why sort by Q?
Sorting by Q, by construction, produces the largest possible valuation spread in the cross-section, meaning the widest possible difference between highly valued and lowly valued companies.
Yeah.
This is important because it maximizes the power of the test to see if the model can accurately capture those significant differences in valuation, not just small variations. It really puts the model to the test.
Makes sense. Challenge it where the differences are biggest. And the results. Did it actually work? Was there a striking fit, as you mentioned earlier, or did the model fall apart under the weight of real data?
The fit was indeed striking. I'd say bordering on remarkable, really. The model predicted a valuation spread, which is the difference in Tobin's Q, between the high Q decile, most highly valued firms, and the low Q decile, the least valued, of 4.45.
Okay, 4.45 predicted. What was the actual number?
This figure is incredibly close to the observed valuation spread of 4.50 in their extensive NYSE, Amex, and NASDAQ Q sample from 1963 to 2011.
Wait, 4.45 predicted versus 4.50 actual. That's tiny.
The error was a mere 0.05, which is only about 1.1% of the observed spread.
A 1.1% error over nearly 50 years of data across a wide range of companies sorted into these extreme groups. That precision is truly remarkable.
It really is.
Are there any conditions under which this model's accuracy might waver, or any data points that prove particularly challenging to fit, or did it hold up across the board?
That's an excellent and critical question. And while the overall fit is outstanding, it wasn't just at the extremes, the highest and lowest Q groups. Across all 10 Q deciles, the average magnitude of the model errors was only 0.07.
0.07 on average error. How does that compare to the average Q?
Well, the average Q was 1.58, so 0.07 represents about 4.5% of the average Q, so quite small. And the visual evidence is even more compelling. If you look at their paper, Figure 1, there's a scatter plot of the average predicted Q against the average realized Q across these 10 deciles.
And
It's almost perfectly aligned with the 45-degree line. That line represents perfect prediction. So this indicates a very strong and consistent fit across the entire spectrum of valuations, from low to high.
wow, a picture's worth 1,000 words there.
It really drives the point home. Now, regarding your question about conditions where accuracy might waver, they do explore that in later robustness checks, which we'll definitely get to. And that does reveal some fascinating nuances about where the model might be further refined.
Good. Looking forward to that. That visually confirms the accuracy and consistency for now. What about those adjustment costs you mentioned earlier? The model estimates them, right? Did the implied costs from the model make economic sense in the real world, or were they just abstract numbers needed to make the math work?
That's another important check. The estimated magnitude of the adjustment costs implied by the model was about 4.78% of sales.
4.78% of sales. Is that reasonable?
Well, this figure is largely in line with prior studies. For example, research by Bloom back in 2009 suggested these costs could range anywhere from 0% up to 20% of revenue, depending on the industry and context. So 4.78% fits comfortably within that plausible range.
Okay, so not only is the model fitting the data with impressive accuracy, but it's doing so with parameters, these implied adjustment costs, that are economically plausible and consistent with other research on how much it actually costs companies to adjust their capital. That adds credibility.
It does.
But sometimes models can fit well, maybe too well, but lack the power to detect when something's actually wrong. Did they stress test it thoroughly to see if it could reveal deficiencies, or was it just designed to always look good?
They absolutely did stress test it. The model was evaluated using more disaggregated portfolios, instead of just 10 deciles based on Q.
They sliced the data finer.
Exactly. They used 20 portfolios, then 50, and even 100 portfolios formed on Tobin's Q. These more granular portfolios, by their nature, exhibited even larger valuation spreads. For instance, the 100 portfolio setup had a massive spread of 14.63, much wider than the initial 4.50 spread for the 10 deciles.
So a much tougher challenge. How did it do?
Even under these demanding conditions, the model maintained economically small valuation errors, often still just 1 to 5% of the valuation spread, which is quite impressive given the increased noise and variation.
But did it ever break?
Well, interestingly, for the most disaggregated portfolios, the 100 portfolio test statistical rejection at a 10% significance level did occur.
Ah, so it wasn't perfect at that extreme level.
Right. But this isn't necessarily a failure of the model.
Mhm.
It actually demonstrates that the tests had sufficient power to detect even minor deviations when pushed at that level of granularity. It shows the testing methodology was rigorous and transparent, not just confirming the model easily.
Okay, that makes sense. So it's a powerful model that fits the data remarkably well, especially at the broader portfolio level where noise is reduced. But it's also rigorous enough to show when it might have limits or areas for future refinement when you really zoom in. That's a very robust and honest finding, giving credibility to its overall performance. The model shows an impressive fit overall, especially capturing that big valuation spread. And we've heard about the power of its practical applications, getting rid of forecasts and discount rates. But I'm curious about the specific mechanics and any hidden nuances that really make it work so well. You mentioned earlier that the non-linearity in adjustment costs was particularly important.
Yes, absolutely key.
Can you elaborate on why that parameter, being different from 2, is so crucial? What does it really do?
This is a truly crucial detail because it highlights a key innovation of this model that allowed it to perform so well empirically. Remember, nu is the curvature parameter in the adjustment cost function. It was estimated to be around 3.75 in the main tests, and sometimes around 3 in more disaggregated tests. What's fundamentally important is that this value is significantly different from 2.
And 2 would be the standard quadratic cost function.
Exactly. A value of 2 implies a quadratic cost function, which in turn means linear marginal cost of investment. But finding nu greater than 2 means the model found that the adjustment costs function is not simply quadratic, but rather it exhibits more curvature. The marginal cost curve bends upwards more sharply.
So why does that matter so much? Why isn't a simple quadratic cost function where costs increase proportionally with the square of investment good enough? What's the intuitive difference in the results?
It matters profoundly Because with a simple quadratic cost function, or E22, the investment to capital ratio would be simply proportional, linearly related to Tobin's Q, a straight line relationship.
Okay.
But with curvature with a greater than 2Q, becomes a nonlinear and convex function of investment.
Convex, meaning it curves upwards.
Yes. Think of it this way. If marginal costs are linear, adding 10 units costs twice as much in friction as adding 5. But if they're convex, nu 2, adding those final 5 units to reach 10 costs more than twice as much in friction as adding the first 5. The cost per unit ramps up faster.
Okay, so the costs accelerate more quickly. How does that affect valuation?
This convexity in marginal costs magnifies the investment to capital spread, meaning small differences in investment rates between firms can lead to much larger differences in their marginal Q, and therefore a larger valuation spread, Tobin's Q spread.
Ah, so the curvature helps stretch out the predicted Q values to match the wide range we see in reality.
Precisely. This ability to magnify the valuation spread is quantitatively important for fitting the actual wide distribution of Tobin's Q observed in real-world data. Without it, the model wouldn't predict enough difference between high Q and low Q firms.
Did they test that directly? What if they forced nu into B2?
They did exactly that. When they tested a restricted model where they forced E to equal 2, assuming quadratic costs, it was formally rejected statistically at the 5% significance level for most portfolio sets.
So the data clearly said no to the simpler quadratic version.
Pretty clearly. And moreover, this restricted model produced substantially larger implied adjustment costs. For example, 21.74% of sales for the 10 portfolios, compared to a much more plausible 4.29% for the non-quadratic model we discussed earlier.
Wow, over 20% of sales is adjustment costs. That sounds way too high.
It often fell outside the plausible range suggested by other studies. So it makes it clear that these nonlinear convex costs are absolutely key to the model's empirical success and its economic realism.
That's a significant finding, revealing that the real-world costs of adjusting capital are indeed more complex and convex than many simpler models assume. It's not just about getting the math right, but about reflecting economic reality. Beyond this crucial nonlinearity, how robust is the model across different types of firms? Did they check how it performed on subsamples with diverse characteristics, like firms facing financial constraints, for example? Those might behave differently.
Yes, they performed extensive robustness checks to ensure the model's broad applicability. The model's fit was tested on subsamples split by various firm characteristics. They looked at financial constraints measured by the Hadlock and Pierce SA index.
SA index. That proxies for how easy it is for a firm to get funding.
Right. SA stands for size and age, and it's a commonly used index. High SA means more constrained. They also looked at idiosyncratic volatility using weekly stock returns, cash flows, and even lagged investment levels.
And how did it do on, say, the financially constrained firms?
For instance, for financially constrained firms, high SA tertial, which tend to have higher valuation spreads and investment to capital spreads, they invest less maybe and are valued differently, the models still fit generally well. The largest mean absolute valuation error for this group was 0.18, representing about 7.83% of average.
So still reasonably good performance, even for these potentially trickier firms.
Reasonable, yes. It suggests the core mechanism holds up.
So even for firms that might be facing extra hurdles, like limited access to capital, the model still holds up and provides a good estimate of value. That speaks to its underlying strength.
Broadly, yes. Similar good fit was observed for firms with high idiosyncratic volatility, meaning their stock prices move a lot independently of the broader market, and even with firms sorted by cash flows and lagged investment.
But were there any caveats, any signs of strain?
Well, these particular subsamples did show slightly larger errors than the main Q-sorted portfolios. And this does raise an important point that the authors themselves highlight. The implied adjustment costs occasionally appeared larger in some of these subsamples.
LR.
For example, 9.21% of sales for the high SA firms, 15.01% for high cash flow firms, and 10.32% for high lagged investment firms.
15% for high cash flow firms seems quite high.
It does. While these figures were still technically within Bloom's broad, plausible range of 0–20%, the authors acknowledge they seem large and indicate possible specification errors.
Meaning the model might be missing something for these specific groups.
Potentially. It suggests that incorporating more sophisticated modeling of financial constraints, or perhaps how adjustment costs themselves interact with a firm's financial health or cash flow situation, could further refine the model. It's an honest assessment of where future work could improve things.
That's a great way to highlight areas for future improvement, showing transparency. What about combining the valuation model with other firm characteristics or equations? Did they do any joint estimations to see how it interacted with other fundamental financial concepts like expected return?
Absolutely. They performed two critical joint estimations to validate the model's comprehensive nature and address potential criticisms. First, they estimated the model jointly with the expected return moment. They looked at whether the model could explain both valuation levels and expected stock returns simultaneously.
And could it? That's often a big hurdle for asset pricing models.
What's particularly compelling here is that the good fit on valuation was maintained, and the expected return errors, the part the model couldn't explain, were economically small and statistically insignificant.
So it didn't mess up returns while explaining value?
Exactly. And crucially, these errors did not vary systematically with Tobin's Q. This contrasts sharply with traditional multi-factor models like, say, the Fama-French or Carhart models, which often show significant and predictable return errors across different Q deciles, like the value premium puzzle.
So their model seems consistent across both valuation and returns, which is quite powerful. What was the second joint estimation?
The second joint estimation was arguably even more important for validating the model's fundamental grounding. They estimated the valuation model jointly with the investment Euler equation.
The Euler equation again, the one that anchors decisions to fundamentals.
Precisely. Recall, the Euler equation, by its nature, does not contain asset prices. It anchors managers' investment decisions on economic fundamentals, their expected future profits, adjustment costs, depreciation benefits, and capital's continuation value.
And why estimate jointly with that?
This was done to address concerns that maybe the good fit on the valuation moment alone was somehow being driven by misvaluation. Maybe managers were investing based on temporarily inflated stock prices, not true fundamentals, and the model was just picking that up.
Okay, sort of garbage in, garbage out concern.
Kind of. But the results showed that the model's performance was robust to the inclusion of the Euler equation. The fit remained strong, suggesting that the impact of potential misvaluation on the benchmark estimation is relatively small.
So the investment decisions really do seem tied to the fundamentals described by the Euler equation, reinforcing the model's economic logic.
Exactly. It strengthens the interpretation that the model is capturing rational, fundamental-driven investment behavior. This aligns with other studies by Cherenko and Schaller and Weir-Sawatharana and Whited, who also found relatively little impact of misvaluation on U.S. investment policy.
That's a strong testament to the model's foundation in economic fundamentals and real managerial decisions, rather than just market noise or sentiment. Did they also look at how it performs in different industries? Because I imagine the cost of capital adjustment varies quite a bit from, say, a tech company developing software to a heavy manufacturing plant building new machinery. Industries are different.
They did exactly that, which is another strength of this research, showing they considered heterogeneity. The model was applied separately to 25 different Fama and French, 30 industry classifications excluding financials, utilities, and a few others, specifically to account for technological heterogeneity across industries.
Using standard industry groups makes sense.
And as you'd expect, the parameter estimates for things like capital adjustment costs varied sensibly across these industries.
Can you give an example?
Sure. The average implied adjustment costs were 5.94% of sales across all industries looked at. But there was a wide range, as low as 0.18% for transportation, where perhaps assets like trucks or planes are more liquid or easier to adjust scale, to as high as 19.42% for healthcare, which often involves highly specialized, regulated, and maybe lumpy capital investments.
Almost 20% in healthcare versus near zero in transport. That makes intuitive sense. The model picks up these differences.
It does. So the model has the flexibility to adapt to the specific nuances of each industry's investment dynamics. That's a good sign of its practical applicability.
But did it fit well for all industries?
Well, the model was formally rejected statistically for 7 out of the 25 industries tested,
Okay, so about a quarter of them.
which, for a relatively parsimonious model with only one type of capital input applied across such a diverse sectors, isn't entirely surprising. It points to potential misspecification in those specific sectors. Maybe other factors are more important there, or the adjustment cost structure is different.
So room for more industry-specific modeling in the future.
Definitely. But even with those rejections, the average valuation errors across all industries remain quite small, around 0.12, which is about 8.7% of the average industry Q. And many industries still showed small Q errors.
So still pretty good overall, even with some industry challenges.
Yes. Overall, this provides robust evidence on technological heterogeneity and, as the authors put it, a good start to understanding valuation at the industry level. It suggests future work could tailor the model even more to specific industry characteristics, maybe adding different types of capital or more complex cost functions.
Despite all this strong empirical evidence, did they acknowledge any limitations, particularly regarding those measurement errors we discussed earlier? Even after using the portfolio level approach, some noise must remain, right?
They were very transparent about it. Even with the strong fit at the portfolio level, looking at the average Q, they observed that the time series correlations between predicted Q and realized Q were not perfect.
How correlated were they?
Around 0.58 in levels and 0.47 in changes over time.
So positive correlation, but far from one.
Right. This suggests large measurement errors still exist at the firm level, which haven't been completely averaged out. And this is precisely why their portfolio-level approach, focusing on the average first moment of Q, is so effective for testing the core theory. It averages out a lot of these firm-level errors, allowing the underlying economic relationships to shine through more clearly.
So the model isn't claiming perfection at predicting every daily stock price fluctuation for every single company,
Definitely not.
but rather robustly capturing the fundamental drivers of valuation across firms, especially when viewed in aggregate or on average.
That's a perfect summary. The rigorous testing and transparency about potential shortcomings only strengthen the credibility of their findings. This model truly seems to offer a new, robust, and economically grounded way to think about valuation.
This has been an incredibly insightful deep dive into a truly innovative valuation approach. So, wrapping things up, what does this all mean for you, the listener? Whether you're an outside investor, an analyst, or just someone trying to make sense of company valuations. What are the practical applications of this supply approach?
When we connect this to the bigger picture, the practical applications are quite significant, I think, especially for outside investors and financial professionals who are routinely faced with these valuation challenges.
Okay, like what?
Firstly, and most obviously, this supply approach provides a robust, fundamentally driven method for estimating the intrinsic value of a firm without many of the traditional headaches we spend time discussing.
That sounds like a genuine game changer right there. No more reliance on those notoriously difficult, often subjective cash flow forecasts or the imprecise estimates of discount rates that can swing valuations so wildly.
Exactly. It offers a cleaner, more objective pathway grounded in observable actions and costs. Secondly, this model can be applied to evaluate the fairness of market prices in crucial corporate finance events.
Like M&A.
Exactly. Mergers and acquisitions, equity issues, share repurchases. When a company's buying another or issuing new shares or even buying back its own stock, this model offers an independent, fundamentally driven way to assess if the price being paid or received is economically justifiable. It provides a vital second opinion, away from maybe deal hype or short-term pressures.
And for equity analysts who are constantly making buy or sell recommendations and publishing detailed valuation reports based often on those traditional DCF models, this sounds like an incredibly valuable cross-check tool.
It definitely provides a valuable cross-check to their traditional present value calculations. It offers an independent perspective rooted in different data and assumptions. It allows them to confirm or perhaps challenge their own assumptions about future cash flows and discount rates, adding another layer of rigor and confidence to their analysis.
That makes a lot of sense. Use both approaches.
And what's particularly fascinating here, I think, is that the supply approach is especially useful for valuing entities where reliable stock returns data is simply unavailable.
Oh, right, because you don't need the stock return data to get a discount rate.
Precisely. Think about valuing a division of a larger company, a private firm that isn't traded, or initial public offerings, IPOs, before they hit the public markets and have a stock price history.
Yeah, how do you value those traditionally? It must be hard.
It's very hard. For these entities, traditional discount rates based on models like CAPM cannot be estimated reliably because there's no public stock return data to derive them from. In such scenarios, the supply approach becomes a more viable approach, potentially,
Why?
because it only relies on observable investment data, which even private companies have, or can be estimated for divisions and an understanding of the capital adjustment technology, those cost parameters like ADA and NU, which is fundamentally technologically driven, not market-driven.
So it might be estimated from industry studies or comparisons.
Potentially, yes. This makes it a powerful tool where traditional methods fall short or become overly reliant on shaky assumptions.
So for entire segments of the market where traditional valuation models struggle, This approach steps in with a robust, data-driven alternative rooted in real economic decisions. That's a truly powerful and versatile contribution.
It really expands the toolkit.
Mhm.
And the authors themselves view their work as only a first stab towards a broader goal,
Which is?
a deeper integration between asset pricing, understanding why assets are priced the way they are in markets, and the equity valuation and fundamental analysis literature that comes more from corporate finance and accounting. They see it as starting to build a bridge.
An exciting prospect, unifying these
It
fields.
is. It's an exciting start to what could be a profound unification of these previously somewhat distinct fields of study.
So what's next then? What are some fascinating future avenues for exploration that build on this groundbreaking work? Are there more deep dives waiting in the wings to expand on this supply approach? Where does the research go from here?
Oh, absolutely. This research points to several incredibly fascinating directions for future work. One obvious one is developing new econometric methodologies for firm-level valuation.
Getting beyond the portfolio level.
Exactly. Moving beyond the portfolio level to try and understand individual company dynamics and nuances even more deeply, perhaps finding ways to better handle or model those firm-level measurement errors. Another huge area involves incorporating additional productive inputs beyond just physical capital.
Like people or ideas.
Yes, like labor, and especially intangible assets, think R&D, brand equity, software development, organizational capital. These play increasingly vital roles in modern economies, but they're notoriously hard to measure and value using traditional accounting or investment frameworks. Integrating them into a supply-side model would be a major step forward.
That makes perfect sense. Capital isn't the only thing companies invest in, and understanding those other investments is crucial for a complete picture, especially for tech or service firms.
Indeed. Researchers could also model more complex adjustment costs. We talked about convex costs, but maybe some costs are non-convex, meaning the cost function isn't always smoothly curved, but might have lumps or jumps.
Like a big factory project having huge fixed startup costs.
Exactly. That might better reflect the lumpy and often irreversible nature of some large-scale investments. And crucially, there's a call to integrate corporate finance frictions more deeply.
Like the financial constraints we touched on.
Yes, things like financial constraints, the potential non-separability between investment and financing decisions, maybe how you finance affects your investment choice, and agency conflicts between shareholders and managers. Managers might not always act perfectly optimally for shareholders. Seeing how these real-world complexities influence valuation through this supply-side lens is a rich area for research.
So making the model even more realistic by adding these frictions.
Exactly.
Yeah.
Ultimately, the long-term goal, as the authors suggest, is to pursue a deep unification between asset pricing and accounting valuation, creating a more holistic, accurate, and fundamentally grounded framework for understanding corporate value. Lots of exciting work still to be done.
Well, this has been fascinating. What we've seen today is a truly powerful and, I think, innovative way to think about equity valuation.
Right.
By shifting our perspective, moving from the investor's demand for securities to the manager's optimal supply of capital assets.
Focusing on those real investment decisions.
Right. We can infer asset prices directly from observable investment data and the real costs of those investments. This approach elegantly bypasses the often imprecise forecasts of future cash flows and those notoriously difficult estimates of discount rates that have plagued traditional methods for decades.
It offers a different path, grounded in different, arguably more observable data.
It really feels like a pragmatic, empirically validated tool for assessing intrinsic value, grounded in economic fundamentals and managerial actions.
And hopefully you, the listener, now have a deeper understanding of how market values can be tied not just to abstract financial models or market sentiment, but to the tangible, real-world decisions companies make about their physical assets and the inherent measurable costs involved in those decisions.
Yeah, it connects the dots differently.
This isn't just about abstract financial theory. It's about connecting a company's concrete, real-world actions to its market valuation in a surprisingly direct and robust way, offering a new path to informed investment.
And this leaves us with a final provocative thought for further exploration. If outside investors can gain such profound insights into intrinsic value from a firm's investment-to-capital ratio and the underlying technological parameters of adjustment costs,
If this supply-side view really takes hold,
how might this knowledge influence the very way companies manage their investment decisions? Or even how they communicate their capital expenditure plans, maybe trying to align with or influence this external valuation lens?
that's interesting. Could it change corporate behavior or reporting?
What new language might emerge between firms and the market, driven by this deep supply side understanding of value? Something to chew on as you go about your week. Thanks for joining us for the deep dive.